Hello and welcome to the Gold, Goats, and Guns podcast for February 21st, 2023. My name is Tom Luongo, and we have a lot to talk about. It is episode 134, and I have the great pleasure of meeting for the first time. Lynette Zang is going to be with me today, and I know a lot of you in the audience have been asking me to have Lynette on the show, so it's kind of come up in conversation, and eventually her people got in touch with me, and I got in touch with them, and we did the thing, and Lynette is the chief market strategist over at ITM Trading. Lynette, thank you for being here today. Welcome to the show.
I'm really happy to be here, Tom. I'm glad we finally connected.
Cool. I haven't had a chance to really to ingest a lot of what you've been talking about recently, but from what I understand, my people have been saying, Tom, you have to get Lynette on the show because she's the only other one talking about this whole SOFR LIBOR thing. And for those of you who don't know, SOFR is this secured overnight financing rate that the United States is moving towards and away from LIBOR, the London Interbank Offer Rate, which we've been on for God knows how long, to the detriment of pretty much every American for the past 4 or 5 generations. You go back as far on that one as you want. So I wanted to start that conversation today. I wanted to start the conversation in that realm, which is, I know what I think about SOFR. I've talked about what I think about SOFR to the cows come home. What I want to hear from you, though, is what you think this is actually, what's going on here, why the Fed's making this shift, why, and why the markets are so, I firmly think, terrified of the switchover from LIBOR to SOFR. So take it away.
And yet they're not talking about it, right? So, what I think about it is they didn't really have any choice when the Bank of England came out in 2012, and the fact that this was a manipulated rate was revealed to the markets. And that's when that shift, when they started to develop these new products to take place of the old products. And, the LIBOR is embedded in every single contract out there. And what has me particularly worried are all of the derivative contracts because it's all leveraged. And the problem is that even as they've come up with this new benchmark that is now going to be embedded in all the contracts, it's all the legacy contracts. In other words, those contracts that are already out there, right, that don't have a clean fix. But even if they do, they have not been able to duplicate the benchmark, the SOFR benchmark, to exactly the LIBOR benchmark. Mm-hmm. So we have hundreds and hundreds of trillions, probably really in the quadrillions, mm-hmm, that will change valuation once they embed this new benchmark in them. Because this new benchmark is not the same as the old benchmark. Even with their jury rig fixes, they still couldn't get it to be exact.
No.
So there are a few things about that. Number one, some people are generating income based on the LIBOR, and the SOFR won't pay as much income. So your income's going to go down. You don't even know it. You're just going to open up your statement one day, and that's how it is. And who you're going to talk to. Mm-hmm. But even more than that, when you look at the stock market and stocks have a certain valuation because of whatever assets they hold or income, blah, 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 that's all going to change. Mm-hmm. And the last time I saw it, so the number could be different now, but probably be still pretty close to the same. There were yet over 610 trillion notional value in contracts that had to shift from LIBOR to SOFR.
Yep.
And whenever you hear the terms notional or nominal, what you actually know is you have no idea how much they're really talking about here.
Right. That's true. I mean, one of the things I always say to people when we start getting into the murky world of derivatives is that, the Wall Street likes to talk about net. Well, there's $610 trillion worth of notional value out there, but it all norms out to like $50 billion or $20 billion, whatever. And it's really not that big a deal. And if necessary, everything, it's not a lot. It's not a problem because, well, this guy pays this guy $50, that guy pays, and everybody goes, oh, and then at the end of the day, it's worth $50 billion. The problem is that notional becomes net when the other guy can't pay, which is the way this is the talking point, or the bon mot I like to use to explain to people that what happens when the chain of all of these all of these derivatives and the collateral change for these derivatives, if anybody breaks at that moment, from there on, the whole thing, notional, from that point forward, notional becomes net because the other guy didn't pay, and therefore you're still on the hook. So it is a worry, right? But
it's a huge worry. I mean, it's never been done before in history. No. It has never, ever, 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 ever been done before.
Yes.
And hey, when they tested it in October 2019, I think it was, with 80 trillion, it was a big fat fail. Because it was 3 weeks after that, they came out and said, oh, yeah, well, we were going to do it in 2021, but we're going to postpone it to June 30th of 2023. That's just a few months away.
It is a few months away. One of the things that when I was thinking about this whole thing with SOFR and LIBOR and all of this, it's there's a couple of things here. And the way I've framed it for people in kind of a high level strategic, because I look at things from a strategic perspective, right? Very much a geostrategist and just games theory kind of thing. LIBOR is that thing that the offshore dollar markets and Europe and Hong Kong and Singapore and everybody else, and most especially the Bank of England and the City of London, have used to control the value of offshore dollars, right? And the LIBOR, because all those contracts that you've discussed, all of those contracts and the derivatives, we're talking debt. We're talking about debt instruments, like straight up loans, and then interest rate swaps to offset the risk of those loans, currency risk or whatever they are, right? That's the thing we're talking about here when we start talking about these derivative contracts. The big issue has always been that if the Eurodollar markets got a cold, then so did the American markets. Even if the American markets didn't have a problem, they weren't having any problem. They weren't having any liquidity problem. Now, when we go back over 2019, one of the things that I noted back in 2019 was that Zero Hedge kept running article after article saying, why is JP Morgan trying to blow up the repo markets or the debt market? And what it was is Morgan refused to take Euro debt, European sovereign debt, trading at historic negative yields as collateral for repo contracts, which made sense. And since SOFR is collateralized with repo contracts, that makes sense. So, of course, at some point, there was going to be a comeuppance here where when SOFR would blow out, because LIBOR blew out, and everybody needed to, and the system, in effect, seized up in that moment. But it was almost like it was a designed moment to wake everybody up to the fact that the world is going to change and that y'all better get off of LIBOR because it's gone and we're getting rid of it. And this cliff has been staring everybody in the face for years, right? And when you think about the history, when you think about that, if SOFR, if the shift from the American the American debt markets to SOFR is successful, completely successful, all that pile of those derivatives you're talking about aren't our problem anymore. In that respect, our banks aren't as exposed to them as possible as they have been. Martin Armstrong's talked about this. Like no U.S. banks are repoing European collateral, European sovereign debt anymore. Like America and Europe have gone their separate ways in terms of finance, and yet somehow NATO is still as we're stronger and more united than we ever have been. Like, really? Not in the banking system. So, part of me is like, I wonder about, this is the thing. I'm like, is this a weapon in a sense? And who's that weapon aimed at? So,
well, I think it's a weapon. I don't think they can make this transition period. And Wall Street doesn't think they can make this transition. So that's why they had to be forced into adopting it. And now, back in 2008, it was the CDOs, this collateralized debt obligations that blew up the system.
Yeah.
Now it's going to be the CLOs and the collateralized loan obligations. Yep. And they're now pushing back because the payments have changed. Everything has changed. And they're like, wait a minute. So, I don't know. Maybe I'm dead wrong. Maybe I'm not. I don't think. Maybe this is a big fat nothing burger. We're going to find out.
I don't know. Right? And I'm willing to it may be one of those things. I know from what I understand, what I've been able to ascertain here. And I brought this up to Danielle DiMartino Booth last week when I had her on the podcast. Mm-hmm. And I said, I don't know if this number is accurate anymore, but I heard recently there's something like $220 trillion worth of LIBOR index debt out there, or contracts debt, mix of debt and derivatives. I heard the number 220 in an article.
Then it's dropped substantially from 610. I mean, and it's possible. I mean,
I'm not. The point is not the number isn't really what's important here. What's ultimately important is it's out there. It even at this late date, if that number is accurate, I'm not saying that it is.
Who knows?
It doesn't matter. Right. What's important is that it's out there and it all can't be indexed to LIBOR because LIBOR is going away in 4 months.
Right.
And now what are you going to do? And if you haven't re-indexed the debt, now from what I understand, most of the U.S. debt has been re-indexed to SOFR. The legacy debt has been re-indexed. Now, again, the interest rate derivatives, no idea. The offshore derivatives, no idea. The shadow, what is nominally the shadow banking system. And those are the ones that are screaming the most. When I brought this up the booth, this is what she said. She's like, who screamed most when the Fed went 75 basis points for the first time? It was the ECB. Because they're the most exposed to this, because they've always had the ability to go and raid the the Mariner Eccles building and the General Treasury account when they got in trouble, because, the Fed would always drop the rates to zero and give them access to everything, because that's what Bernanke and Yellen did. But Powell's not doing that. Powell's literally taking all their money away from them and saying, if you want dollars from us, and if you want U.S. Treasuries, if you want collateral, you want dollars from us, you got to buy it at our price, because he shut everything else off. So he opened up a foreign repo facility, but it's at whatever the Fed funds rate is, which they don't want to pay. Right. So, I've been tracking SOFR versus LIBOR on a day-to-day basis, like 1 month and 3 month LIBOR versus SOFR. And what I've noticed is that as we approach each FOMC meeting, that the LIBOR rate rises to anticipate what the Fed's going to do. And it's been kind of consistent, except now we're within 30 days of the next FOMC meeting. Excuse me. And LIBOR still sitting 4 basis points over SOFR. And 3 month LIBOR is 30 basis points over SOFR. And the Fed's talking about going 50 basis points. There's a rate shock on the horizon. And I don't know if I look at it and I say, well, clearly someone's trying to blackmail somebody. So, right?
I mean, a lot of people think that all they're trying to do is kick the can down the road and keep the same system and everything in place.
Right.
I don't really think that's necessarily true. I really think they know that this is the end of the road. And so they need to have a big enough crisis to cover all of the other stuff that's really happening.
Right.
And make a transition, justify the transition into, this is not, the other thing is, I think people think, oh, well, they'll introduce the CBDCs, we'll have a new currency, and that'll be it. I don't think
that's what they're hoping for in Europe.
Well, they may be hoping for that, but that's just hopium, isn't it?
I agree.
I mean, silly. We can hope for anything that we want, but I think the reality of what we're going to get is much different. And what they're, so I don't know that they're really trying to kick the can down the road. I can't tell you that the World War III isn't a planned cover. I can't tell you that a lot of the things that I'm seeing just aren't planned cover for a transfer event. And so maybe the LIBOR SOFR thing doesn't really matter at all, because there's going to be a big enough crisis happening before that that'll cover, that'll provide cover for it. I'm just not convinced that it's what a shocker and an unintended consequence. I think what's happening is very intended.
No, I agree, and I think that I think the part that might bake a lot of people's noodle. And this is what I've been saying for a while now. I remember I'm this hardcore Austrian, like I have a picture of Murray Rothbard on my ceiling when I go to bed at night. Like I want 100% reserve banking. I want the world back on, hard asset standard, but that's not the world I live in. So I can't analyze the world from that perspective. I have to analyze the world from the perception, the world I've got, not the world I want. And this is part of this is, quick editorial. This is my problem with so many people in this part of the space, is that they keep analyzing the world from the one they want, not the one that they have. I'm not accusing you of that. I'm just saying this is the Peter Schiff crowd that just drives me nuts, which is why Peter will never be on my podcast, because he'll probably want to punch me because I'll just tell him he's an idiot. But that being said, because he's been peddling the same shit for 15 years and I'm just not interested in hearing it anymore, because it's not actionable information, right? What's actionable here is this worry that, okay, so what does this transition mean? Well, what if the goal here is the separation of church and state, which in this case is, the European church from the American state, or however you want to put it, meaning there's a split that's happening here. And this is foundational and this is profound because I hate to say this, but City of London has been running U.S. financial markets. For
absolutely.
What 200 years since the day Cornwallis surrendered at Yorktown, right? So, like, it makes perfect sense to me when I look at the SOFR thing. I'm like, yeah, guys, you can do whatever you want. You're going to hang. We don't care anymore. We have to protect ourselves because the system that exists is collapsing, and the best you can do is create a node of stability as best as possible. And, hey, we're the biggest financial markets in the world. We have the most powerful central bank in the world. We have the most powerful currency in the world. So we're going to save ourselves and let everybody else hang. Well, you could have come along for the ride, but you decided that you wanted to destroy the concept of commercial banking. Right?
Well, I think, boy, there is a lot there to unpack.
I know, but this is the way I view the world.
Because look, I was a new stockbroker in the 80s and I heard about globalism. And I remember thinking to myself, yeah, I can see some problems with that. And so we shipped everything away. And it looks like we're in the practice of deglobalization now.
Yes.
However, when you look at the integration of the monetary system, I'm not so sure, because these CBDCs that they're talking about, I mean,
they're awful.
It's global, but they're going to end up, if they have their way. And I'm not absolutely convinced that they can have their way. If enough people really understand what's happening, then we can retain some choices and perhaps have a more system on the other side of this. Mm-hmm. But I think it's all about misdirection. I really do. I think we're going to end up. It is. And so even when it seems like who are we really fighting? Like, it really, is this just a war between Russia and the Ukraine? Or is this World War III already unfolding? And is a bigger weapon the cyber weapons that they're using, but they're using boots on the ground because that's what the normal person recognizes as a war. I mean,
this war, World War III started in 2014 when Russia reunified with Crimea because they refused to use neocon language to say that they annexed it because they didn't.
Right.
Regardless of whether you think they were justified or not, look, the Crimeans didn't want to be part of Ukraine anymore. But World War III started then. I could even make the argument when Obama made the decision to move into Syria in 2011, we could have, because it effectively is a domino chain since then. The misdirections are the conflicts. Are the kinetic conflicts and the trade conflicts are all that. The real problem, as you know, again, I bow at the altar of other people who are much closer to this than I am. People like Martin Armstrong and yourself and other people. I'm like, look, it's very simple. They have a system that's failing. They need to figure out a way to run the cover story on it. And World War III is they can work with World War I and World War II. We might as well do it again. Right. And I mean, it's not hard. These people are very smart, but they're not very clever. They use the same tools as long as they keep working.
Exactly. Right. Exactly. You hit it on the head. I think it was Ron Paul that said it is not a coincidence that the era of perpetual central banking and the era of perpetual war coincided. That is not his exact words, but that's
that's basically
what he said. And it's true.
Yeah.
We've been in a perpetual state of war since 1989, and that is a really good cover for a lot of inflation, a lot of money, a lot of everything. And so yeah, I mean.
So when I think about the whole SOFR to LIBOR transition, to me, I can, and this is where this is the way I've kind of placed it, is like, look, I don't ever ascribe altruism to people who have power. Like, I just don't buy that argument. So, but if you've got groups that are now talking in terms of existential threat to their own future existence, in the case of, we have a whole bunch of, for lack of a better term, Eurotrash commies who want to do away with commercial banking and public and private assessment of risk capital, which Bernanke and Yellen sets the stage for with the way they prosecuted QE and the zero bound and everything that they did. The Fed put basically architecting, thanks to Greenspan, the Fed put. If Powell is trying to get rid of the Fed put, whether he's successful or not is a completely different issue, but it's clear that he's trying to get rid of the Fed put. He's trying to work markets through the Kubler-Ross 5 stages of grief to say, no, really, it is going away. Now you need to get over yourselves. And today, and we're recording this on February 21st, it was a massive rout in the bond market today. Not only was there a massive rout in the bond market today, there was a massive rout again in the Eurodollar futures market, which was down across the yield, the latter end of the yield curve, anywhere from 9 to 15 basis points. So
that's
the euro, it's massive. Like when the Eurodollar futures curve moves more than 3 basis points in a day, it's a massive move, right? And this is the third or fourth day like this since the last FOMC meeting. Okay, so I mean, to me, what I identified when I saw that Jerome Powell was not going to go along with Christine Lagarde to inflate to infinity over climate change, like from there, it's just a matter of this is now all at war. And the real warfare is between the U.S. and European banking interest. And then with the Russians and the Chinese and the Iranians going, you know what? Hey, we don't need to be a part of this. You guys fight it out to leave us out of it. And of course, the political side of this is saying, oh no, you can't get out of it. We have to, this is Hotel California. We have to fight World War III so that we can have our cover story. And in broad strokes, I think that's the broad case on this. And I think SOFR ties into that by getting rid of the control of the City of London and or the rest of Milan and the Vatican and all those guys out of the U.S. banking system, so that our evil plutocrats, the Jamie Dimons and the Solomons and the rest of those guys, well, they can have control. They can have more control over this thing than the old money, and then we have to fight them once they're done winning. But in the short term, for the United States and for the U.S. dollar, I hate to say this, but if I have my choice between Jamie Dimon and Klaus Schwab, I'm choosing Jamie Dimon every day.
I think so. I'm not a fan of Klaus Schwab, honestly.
No, I didn't think you were. No. So I mean, and this, but again, but what do you think? Do you think Schwab is? I don't even think Schwab at this point is an actor. Is a prime mover. I think he's an order taker at this point.
Oh, I think they're all. Yes, I think actually they're all order takers, and I never take my eyes off the IMF because that's where they all meet. Right. So they all meet, they're all discussing this. Is it really, that takes me all the way back to, is this just happenstance or is this really everything being a planned event? Because it doesn't matter where you are in the world. The fiat currencies have no purchasing power left. And we're elevating into a full surveillance economy. And these things happen slow until they happen fast.
Right. Agreed. Right. Yeah, no, agreed. And this is where I'm going to have Vince Lanci on the podcast later in the week. He and I are going to finally sit down and chat VBL. And he's been banging his shoe. I mean, I always use this, right? He's banging his shoe on the table like Khrushchev, saying the Russians and the Chinese are about to go with a full digital gold-backed currency, and they're going to drop it on us like tomorrow. Like they're going to drop it on us soon. They're starting to talk. The Chinese are starting to talk in very, very serious propagandist terms in local propaganda to get the the average Chinese to buy and hold gold, and then once they digitize it and move, and basically replace Swift,
right,
and move that stuff across that kind of that backbone, at that point everything changes, and this is why I think
everything does change. But here's my question, and I don't know what the answer is. This maybe you have an opinion on this as well. Is the current system based on debt? If they cannot put a component of gold in the current system where it locks in the debt where it is, and they have to have the ability to repay that, get rid of that debt. And typically they do a hyperinflationary event,
right,
that burns off the debt and you can start again.
Right.
I was talking to a guest earlier who feels that there'll be a parallel system so that they don't have to worry about burning off the debt here. They'll just bring in the CBDCs.
Right.
If they bring in a CBDC backed by gold, I mean, I just had this conversation, so I'm still kind of mulling it over and thinking about it. I don't know how they can bring in just a parallel system and then just have this quietly go into the night. I think since this is a wealth transfer mechanism and the CBDCs will give them absolute and utter control, I think we have to have that hyperinflationary event because there is no soft landing for anybody.
Well, one of the things that I've thought about on this, and again, I also don't know that it's going to be the same kind of a central bank. I don't think they can get away with a gold-backed central bank digital currency. I think it'll be something. I think it'll be some other type of.
Not initially.
No, certainly not.
Ultimately,
but I just think like if you really think about it, the Russians have already effectively soft pegged the ruble to gold. The Chinese have already soft pegged the yuan to gold. I don't think that it's actually necessary to do that unless you're talking about what's important here is for the Russians to be able to demand with a payment layer their raw materials in gold. That is going to be the big shift. That's the big issue. I'm less convinced about the whole tokenization of gold as a medium of exchange kind of thing. I do believe that they can do something like that in order to encourage savings, right? But they already have encouraged savings within the Chinese economy. They already have that. Like that's much more natural. And whereas we have a Keynesian system that says, oh, the paradox of thrift is all powerful, therefore savings is bad. And note everybody who. So what I'm thinking here on this is that's the thing I'm really more worried about, right? Because that is what the Fed and the West have to respond to, and they can't respond to it with a classic hyperinflation. And it's the George Soros, which you're laying out as the George Soros argument, right? To repudiate the debt, issue perpetual debt at 0.25% or whatever, pay it or 2% or whatever. That's what he's talking about. He keeps saying that's how the British Empire financed itself. But it's clear that that's what they want to do. And then they'll issue a digital euro payable off of those consoles. But I just, if they do that, can you see anybody ever investing in Europe ever again?
No, I can't see anybody. Here's the thing. The whole thing is a Ponzi scheme, even what they want to take us into, right? That requires confidence. But what's been amazing to me is how easily they have given all that confidence away. So bank-to-bank confidence gone in 2008, interbank lending. Central bank confidence to central banks, that was gone in 2015 with the Swiss surprise.
Yep.
And then in August, markets to central bank confidence gone with the getting rid of the forward guidance.
Mm-hmm.
So what layer of confidence is left? It's public confidence. Right. So they may want whatever they want. That too is hopium. If they can't get control of the speed of inflation, the rate and speed of inflation, then the public will lose confidence. If they can keep it super low, people don't realize it. So they maintain that confidence. But this is a con game. It really is all about confidence.
Yep. Agreed.
And so if you don't trust this currency, are you going to automatically step into a new one that they create? Probably not.
No. but
That
they'll give you no other alternative. That's what they're trying to do.
Well, yeah, look at Nigeria.
Yeah.
Nigeria.
Well,
look at what's happening there. The public didn't adopt the CBDC, so let's demonetize most of the currency in the large bills, which are worth about $2.
Right.
Right.
Yeah, no, it's the same thing that they got Modi to do in India a few years ago.
2016.
Right. No different. Yeah. Same thing. And then Modi has what's the word I'm looking for? I hate to say grew. He's regretted that decision ever since. Because after that,
tell you that?
No, I know, but you can see it in the way he's prosecuted. Modi is a very interesting figure. I don't want to go too far off on a rant, but I think that Modi is a very interesting figure because I think COVID exposed just how little they think of India and how much they were willing to destroy India in order to get stuff done. And I think in the last 2 years, certainly since late 2020, India has shifted completely away from the West. And now they're looking very seriously at what are we going to do going forward. And that's why they're making bilateral trade deals with the Russians and all this stuff in order to try and get stuff done. And I really do think he's regretted the decision to do away with the large denominations of cash. But regardless, it is what it is. I just think I'm almost positive about that at this point. But it's a minor point. Your point about them wanting whatever it is they want, and all of this is a Ponzi scheme, and everything else is all very well taken. It's de rigueur. The issue is which Ponzi scheme collapses last. Right. See, the way I've looked at it for a long time, this is why I argue that the Federal Reserve has the Federal Reserve has aces where everybody else is fronting that they have aces. They flop their set and everybody else is just trying to hit an inside straight draw. Doing a Texas Hold'em thing because they're the biggest Ponzi scheme, and the biggest Ponzi scheme can collapse all the smaller Ponzi schemes.
Oh, too true. Oh, right. Too true.
FTX was a classic example of how they did that in the crypto market.
Yeah, I mean that's pretty simple. Right. But the IMF has been preparing for that too, haven't they?
Yes,
with
they
their
have.
Substitution fund.
Yes, they have.
And they can expand that currency. It's a basket of currencies, so they can expand it, and we can have a global currency and a local currency. But again, it still goes back to the public confidence.
Yeah.
So when they first bring it out, and that's what I definitely want people to realize. Just when they first roll out the CBDC, it does not mean that it's over.
Right.
It just means that they're moving you into the next phase of their plan to rob you. That's why I hold it. I own it outright.
Yep.
Right.
She's holding up. Just so you know, this is an audio podcast only. She's holding up big old gold coins here. So we're only doing video.
Pretty for today.
What's that? I'm sorry. Yeah, I shave only for these things just as a matter of courtesy for my guests, but I only ever do.
Yes, and I am holding physical gold, physical silver in my possession. I'm a tangible gal.
Yeah.
Now, that is not necessarily going to be. I'll always have some gold and silver as the foundation of my, of my wealth. Because that's also easy to pass down through generations, and I'm old. How much longer am I going to be here?
I did a great podcast with a friend of mine the other day as a crypto hedge fund manager. My name is Chris Sullivan. He was just talking to me. He's like, Tom, there are 5 assets in the world. Everything else is just money that you use to accumulate those assets. And he considers Bitcoin one of them, but it's commodities, gold, silver, real estate, and Bitcoin. There's really nothing else because those are your bearer assets that have an opportunity cost associated with the production of them. And you can even argue that stocks to a lesser extent, but in this environment, because stock valuations are so effectively ludicrous. Mm-hmm. But unfortunately, because the bond markets and the leverage loan markets and the credit markets are so enormous, stocks can sit here at these enormous valuations for a long, long time as people think they're going to tangible, because they can go from bonds and or this other ephemeral crap, and they can move into, well, at the very least, I get a claim against the property, plant, and equipment of this company. It's something. It's got people, it's got stuff, it makes products. And this is part of the reason why, we're seeing, why, and they're also, when you really start to think about, if we're looking at some kind of large event, why stocks have to be lumped into, blue chip stocks have to be lumped into tangible assets, because in the short run, because people are going to run from one asset class to another, stocks can actually do very well in that environment, especially blue chips, because they're big pools of liquidity. There's not enough liquidity in the gold market if everybody rushed into it and without moving the price. And this is always the biggest issue is what is the real big pools of capital? What do they do in a crisis? They can't all just buy gold. I would love it if they did. I'm not arguing here. Remember, gold, goats, and guns. It's kind of the name of the podcast.
I get that, but see, it kind of almost sounded like if everybody goes into gold, then that's going to impact the price. But if you look at how much gold the central banks, who are arguably biggest buyers of gold, if you look at how much gold they've been buying since 2005, I'm going to take you to 2005 because that was really when we were at a bottom where they were leasing, selling, blah, 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 whatever they were doing.
Yes.
And they just bought more gold than they have in 57 years in 2022.
Agreed. Yep.
So,
it's coming. Everybody's prepared for it.
What's I tell you? But yet we see the spot price at 18, whatever. Give me a break, right? Well, it's so far below the fundamental value. And this is true of all assets. So even when you're talking about blue chip stocks, are you really going to go, that's my brick, right?
Right.
These corporations, not all of them, but a big, huge chunk of them are so leveraged. Yeah. We don't even know, because so much of this is done off balance sheet and with derivatives and using all of this,
gearing,
all of this. Yes. I mean, it's just garbage. So, and even, people know how I feel about Bitcoin. I don't think it was a coincidence that it came out in January of 2009 and QE started in March of 2009. How much money would have flown into physical gold had they not had Bitcoin as an alternative? I don't know, right?
I don't think a lot of. I'll be honest. I'll be honest with you. Just looking at the marginal flows into Bitcoin, they're actually quite small relative to the valuation. I'll be honest with you, because I've thought about this at great length, and so I've had unbelievably long conversations with my partner Dexter White about this, and because we've been thinking about this for years. But what I'll say is this: the coincidence, we could also argue that Bitcoin was an idea in a lot of people's heads for a long time, and just waited for the moment when the financial system broke and said, "Oh, by the way, here we go." And it depends on whether you think those were malign actors, or those were white hats, or those were black hats, or were they gray hats. I know what I think, right? I was there at the beginning of Bitcoin. I was there in that community, and I went, looked to me like a whole bunch of really hardcore, ungovernable libertarians, like trying to figure out a way to get around this nonsense.
It's the same mentality. The people that own gold and go to gold have the same mentality as people that go to the cryptocurrencies or Bitcoin. Bitcoin, I hear from everybody, is different than cryptocurrencies, and they should not be lumped together.
Well, I just to remind everybody, I'm a proof of work maxi, so I'm a Bitcoin-like coin maxi. That doesn't mean that I think Bitcoin is. I'm not a Bitcoin maxi in that respect. I'm absolutely a proof of work maxi. Like I'm in that respect. I think proof of work is a technology that is foundationally transformative, right? And that also in that respect also for other tangible assets like gold and silver as well. But it's a much more complicated discussion. And in the world we have today, after 15 years of zero bound money, you can destroy valuations of everything, and then everybody is unmoored from any kind of emotional restraint, and manias happen, and it's just all a mess. And Bitcoin has been a victim of this as much as oil. I'm more worried about the volatility in oil than I am about the volatility in Bitcoin. I'm more worried about the volatility in oil than I am about them continuing to suppress the price of gold. I look at that as a gift. Every day I wake up, I go, oh, look, gold's under $10,000 an ounce. I'm like, I can't write the check fast enough, right? But when I look at the volatility in oil, it actually really bothers me because, and I do a very simple thing. I just chart volatility. My definition of volatility is very simple. I just take the standard deviation of the weekly range and divide it by the price and go, dude, that's our price, right? That's volatility. It's standard deviation of the, and oil is trading at is 6%. It's over 6.5%. It moves on a weekly basis.
That's huge.
The weekly range, low to high, is like $5 or it's $4 or whatever, over $5.50 over a price of $83. It's 6.4%. It's 20% on a monthly basis.
That's outrageous.
It's insane.
Yeah, it's insane.
And it's tripled in the last few years.
Mm-hmm. Oh, yeah.
And we know why. Because the easiest way to destroy an economy is to make energy production uninvestable in the long-term sense. And so they're screwing around with the oil markets.
Yeah, they are.
What scares me more than anything else, because now we can't rationally plan for the future at all.
Well, solar.
No. Solar. Okay. Thanks, Lynette. That was a good. I really enjoyed that one. That was rich, love. I really appreciated that one.
Yeah.
I one of the things I've been saying is I'm beyond MAGA. I'm now into Moya. Make oil investable again. It's like this is one of my things. So I don't know. And that tells me that it's another front in this war. Right.
Oh, no doubt about it, especially when Saudi Arabia comes out and says, well, we can accept other currencies. We can accept gold for oil. We can accept rubles or whatever. Mm-hmm. So, yeah, I hope that the U.S. isn't so arrogant to think that there isn't something that could topple this regime, because this regime has really been falling down really since it was the end of 2000. I think December 13th. Don't hold me to that date, but that's the one that's in my head. When the Federal Reserve first started buying treasury bonds.
Yep.
2000, December 13th, 2000. Mm-hmm. Wait a minute. What does that tell you? It tells you there wasn't enough demand out there for our bonds.
Right.
But they didn't tout that as a good thing until, of course, 2009.
Right. Now,
Bernanke, the best thing since sliced bread.
Yeah. No. Yeah. Well, Bernanke was trying to save Europe. Don't let anybody kid you. When I spoke to Daniel Booth about this, and she's painted the picture that Bernanke and Yellen are just egghead, easily manipulated egghead intellectuals and not market makers. I'm like, well, yeah, that's clearly obvious. And I think she used the term shockingly naive about how their policies can be manipulated, right? And which is a beautifully
that's a little scary,
right? If you right, so I just prefer to look at Yellen and Bernanke as sinister because it's easier, because then all of their stuff makes perfect sense. But no, they could just be incompetent, and now Yellen has clearly become sinister. Like the way she's running Treasury is clearly against the Federal Reserve. She's running her own QE program to put her thumb on the 210 inversion to keep it as high as possible, because she's trying to undermine the Fed to get the Fed.
She has. Look at conditions are as easy as they were before they started raising rates.
Right.
There you go.
Right.
So what did they accomplish? So
I know they're raising rates to bring confidence back is what they're doing. I mean, to speak to your point originally, the reason you raise interest rates is the Federal Reserve raises interest rates is because clearly they need to raise the return on their primary asset, the dollar, to get people to buy it. That's right. So that's why they're raising interest rates. They're not raising interest rates, and inflation is just the cover story. The cover story is not inflation. The real goal here is to restore confidence in the dollar and destroy the offshore dollar markets. Clearly is what they're doing.
Clearly?
In my mind, yeah.
Because I thought he was raising rates so he could drop them again.
No, I don't think he's going to drop them. I don't think Jerome Powell's cut from the same cloth as Bernanke and Yellen.
No, I don't think he is. And I don't think he's cut from the same cloth as Volcker either.
I think he's cut from a different cloth from Volcker.
Yeah.
I mean that actually I actually think he's better than Volcker, to be honest with you.
Well, I don't know that I have a high level of opinion of either one of them, actually.
Relatively speaking, as Fed chairs go, remember, world we want, not world we got, or world we got, not world we want.
Totally. World we got. And I'm looking at the world we got, and I'm seeing that we really need a big crisis. We really need a big crisis. The central banks know that this is over, and I think they're trying to engineer it.
Maybe. I think I am half on that fence. What I think Powell is trying to do is he is trying to engineer a part of a crisis, right? And I mean that sincerely. It's just where is that crisis going to be located? I look at the current situation with the Fed, and I say this: they got $2 trillion sitting in the reverse repo facility. They've got $5 trillion worth of USTs sitting on their balance sheet. They've got all this. They've got collateral. They've got liquidity. Whatever the banking system needs, they have it and they can provide to it. As they've raised rates, and then we're now getting to the point where rates are above the PCE deflator. Value that for whatever you want, but the market is beginning to believe that there's real yield in the money market funds. Okay, and for that reason, we have seen. For that reason, we have seen the reverse repo facility drop from $2.5 trillion to $2 trillion. Will it continue to drop from there? The Fed's going to have to go higher if they want that money back, and that's why, in many ways, credit conditions aren't good. I don't know about you, but all I've seen are, hey, oh, by the way, your the rate on your HELOC's going up. If that's all I'm seeing. I'm seeing credit conditions are going to collapse very, very quickly.
Yeah.
And rates are much higher than they were. Car loan rates are higher. Someone has to take it.
Yeah.
Right. Either they're going to have to cut prices dramatically.
Delinquencies are now going up pretty substantially. I mean, they haven't triggered anything yet, but definitely, it looks like that's in play. Because
Absolutely.
When you have debt, you have to service it. You have to roll it over. You have to pay it off.
Yep.
You got to do something with the debt. You can't just go, oh, I got it, and it's sitting over there.
Well, the thing is that what the Fed has done here, and this is why Yellen is so angry, and this is why Biden is so angry, is because they're looking at a massive debt rollover right around the same time as LIBOR goes away. It's the other thing that no one's talking about. Yeah, exactly. And if you want to end if the goal here is to look, the Fed is dealing with the first real challenge to dollarization.
Yes.
In the last 70 years.
Yes.
Last 50
I'll agree
years.
with that. Yes. Okay.
Well, if you're the Federal Reserve and you're looking at that and you're saying to yourself, okay, but I got Congress spending in ways that make drunken sailors blush, how am I going to stop that? Because otherwise the dollar's toast and I don't exist anymore. Right. And the Fed works for and represents the commercial banking interests of the United States. Doesn't represent us, represents the commercial banking interests of the United States.
Yep.
And they're all going to go under if there's no dollar for them to lend in. And if the rest of the world says, you know what, we're done with the dollar. Not tomorrow, but death of 1,000 cuts every day. The global reserve currency falls off it's a process.
Yes.
But if the Biden administration says we want to go to war, because you bad Russia, you evil bad Chinese supporting evil bad Russia, blah, 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 stupid, dumb, idiotic crap over and threatening nuclear war effectively.
Yeah.
What do you think? Can you not see the break here? The Fed is trying to stop de-dollarization, or at least slow down and manage de-dollarization. The Biden administration is running hell-bent into accelerating de-dollarization. And so how do you stop this? You raise interest rates to the friggin' roof and you turn to Congress and go, stop fucking spending. That's it. Those are the only options. You throw it back on the Congress and say, this is your job now. And Powell, as a Fed chair, has actually thrown Congress under the bus multiple times in public. Said, well, if you people don't stop spending, I can't do anything. I can't stop inflation. Now, the Fed chairman has never done that before. Not even Volcker did that.
Yeah.
I don't know. This is what it feels like to me. It feels like there's this thing happening that we've all kind of got it wrong for a long time, and that like everybody's ox is being gored. Who wants to be the last guy standing?
I want to be the last guy standing. That's why I have gold, exactly, and silver and food, water, energy, security, barterability, wealth preservation, community, and shelter.
Agreed. All of those things. I want to get out of that stuff.
And everybody in my whole community.
Yes.
I want everybody that matters to be the last one standing and to have all this wealth transfer our way for a change.
Yes. Absolutely. And here's how that can happen. You ready?
Yeah.
Judy Shelton, who Kamala Harris and John McCain high-fived and fist-bumped on the floor of the Senate to block her nomination to the Federal Reserve Board.
Actually,
talked about this
a lot.
What's that?
I like Judy Shelton a lot.
Okay. And what has Judy talked about? Judy's talked about 50 and 100-year debt, throwing a 5% gold redemption clause on the back end of it.
Yeah.
You throw gold out on the yield curve.
Money.
You throw the gold out on the yield curve. And that's how you restore confidence in the dollar, which is, to me, the strategic move to counter de-dollarization. But that doesn't happen if you've got a bunch of freaking criminals running at the top of the government.
Yeah. Well,
I mean, this group of criminals is even worse than the normal group of criminals because it's Obama's group of criminals under pressure to get shit as much done as possible before the middle of 2024. That's what I see. And
that's not a pretty picture.
No, it's not. It really isn't.
No, it really isn't. So you got to be as independent and self-sufficient as possible.
Agreed.
It's the only thing that you can really do.
Agreed.
That and not buy into. I mean, that's what prevents having physical gold and silver in your possession prevents you from being completely tied to the new monetary system.
Yes.
That it retains your choices. It retains your freedom. That's why central banks are buying it. That's why individuals should become their own central bankers and buy it.
I agree. The only thing I would add to that is that don't be religious about it. In the short term, Bitcoin gives you other optionality because Bitcoin is easier to move. Because physically, Bitcoin is really easy to move. It's a thumb drive. It's a set of keys. It's a piece of paper in your wallet, and you can move tremendous amounts of wealth in 15 minutes or 10 minutes anywhere else, and you can take it with you in a way that can't move gold across political borders anymore. They've shut that down. And
I just did it in Canada. I was doing VRIC up there, and I mean I didn't bring a lot. Because I don't travel a lot with it. But I brought gold, I brought silver, had them in my purse. Nobody asked me a thing.
Sure, but I mean. Okay, I will amend that.
You're talking about substantial.
I'm talking about generational. I'm talking about generational wealth. I'm not talking about a couple of coins or whatever. But yeah,
I could hold generational wealth. I mean, I don't have an $8 million coin, but I could, right? And that is generational wealth, and it looks just like this, maybe a $2,000-$3,000 coin.
Right. Fair enough. That is a fair point. It is. That is another layer to the whole gold argument. That is, it's one that I don't usually interface with. I keep it very simple for people. What's the first rule of buying gold? Buy as much metal as you can for the dollar you're putting on the table. Whatever's on sale is what I'm buying. But I don't tend to.
It's all on sale. I'm telling you right now, it's all on sale. And I had an experience when I was 10 years old that has stayed with me my entire life. And I didn't really understand it when I was 10, because why would you?
Right.
But my Uncle Al, thank you so much. My Uncle Al was a major antique, very high-end antique dealer back east. And I was at his house with my parents one day, and he said, come here, I want to show you something. And he took us in the back bedroom, and he had 2 tall floor safes in there. This was 1965, by the way.
Wow.
And he said to my parents and me, I mean, I wasn't really paying a lot of attention, but he said, if anything should happen to me, Aunt Bertie will be well taken care of for the rest of her life because of what's in these 2 vaults. And I turned around and I looked, and they were packed with 1-ounce gold coins. Probably, knowing what I know now, right? Probably at least 3,000 ounces, when it was illegal to hold more than 5 ounces, except in the way that he was holding that, because I want to be able to use them in the normal public. So we could have that conversation another day, because a lot of people have more of that mentality of just as much as you can, as cheap as you can get it. But you said earlier, you're a strategist. I am a strategist too. And I've been in these markets on some level my flipping entire life. There is no doubt in my mind that I have been groomed for this moment in time. And I always like to, number one, know what the true value of an asset is, because ultimately, I don't care how much they suppress the price of this. This is worth a minimum of $15,000 an ounce, even though spot is at like 18, whatever it is. Right. So it's all on sale.
Yes.
Generally, I don't go above fundamental value when I buy coins, but it depends on what I'm trying to accomplish. So what I encourage everybody to do is establish your goals. What are you trying to accomplish? Then, after you have your goals established, then you can decide, oh, this supports this goal. This supports this goal. This supports this goal. So it isn't one size fits all, because we have to be strategic in it. But I got news for you. If I 100% know that something's worth 15 grand and I can buy it for 2 grand, 5 grand, 10 grand, 13 grand, it's a bargain. And the more of this garbage, and I know you can't see me, but I'll do it anyway. Okay, I've got a money gun, right? The more money printing and shenanigans and crisis that we deal with, the more this is worth. It's so simple. So this is what is going to put me in a position. But, you know, for me, dynastic wealth is critical, because I'm looking at my children, my grandchildren, and eventually my great-grandchildren. And I want to make sure that they have choices.
Yes.
I want them to have the ability to dream, and then to be able to have those dreams come true. And if it's in the system that those in power have in mind for us, they won't have any of those options. They will be gone except to a select few. I hate to say it, but I want everybody that's listening. I want everybody that's in my family. I want everybody that's in my extended. I want the normal person to retain those choices.
Yes. Yes.
Period.
That is exactly correct. And a lovely sentiment, because that's exactly what we preach here on a regular basis as well. I try to keep it simple for the newcomers to gold, because invariably that's what I wind up with. But I don't get me wrong, I'm not above a little bit of numismatic speculation here or there. What I'll tell people is, hey, look, if you buying this year's, for example, if you're going to be buying this stuff and holding on to it for 10, 15, 20, 30%, however long, until you need it, right? You're going to hold on to it for that long.
Right.
Buying today's, making sure that you buy a little bit of, I'll buy a little bit of this year's Chinese pandas, or this year's Perth Mint stuff, or whatever, because you never know when that stuff is you're going to pay an extra couple of percent over spot than you would, say, buying American Eagles or old old British sovereigns or whatever, you'll get the potential for massive return later on in collectible value, because though you never know what the print runs are going to be, you never know what coins are going to be valuable. Yeah, it happens. And so every once in a while you wind up with stuff in your hand. Okay. You're like, well, gold's trading for $1,800 an ounce. Why is this thing worth $5,000? Because there are none of them out there. So if you do need to sell into strength, you can do so, and you'll actually cover all of it. That's what I wind up. But I never, I don't deviate much from that, for many, many reasons. And because honestly, it's just, there's never enough money to buy all the things you want to buy. So,
well, I don't know if that's necessarily so either, but it's a strategy, and it really is all about a strategy. And so, I'm just going to go back to, I also like to look at things and go, what if I'm right? And what if I'm wrong?
Sure.
And if I can do something that doesn't matter whether I'm right or wrong, that's my choice. Rock and roll hoochie coo all day long.
Right. Agreed. That sounds good. All right. Is there anything else that we want to cover before we wrap this up?
Well, I think we've covered some interesting topics. This has been fun. Thank
you
for having me.
You're more than welcome. I enjoyed the hell out of it. Because I always enjoyed the hell out of my podcast, because I only have people on that I like talking to. So
there you go. That's the way to do it.
Yeah, this has been an absolute blast. I really have enjoyed it very, very much. So we will do this again, hopefully, and I'll have my people bring your people. We'll do lunch. That whole thing. You be there well. If you have anything else you want to say to anything else you want to plug before we get out the door?
I would really just say, we have two websites. So ITMtrading.com and beyondgoldandsilver.com. So where we deal with all those mantra things: food, water, energy, security, barterability, wealth preservation, community, and shelter. We have YouTube channels on both of those issues, and we're very prolific on what we put on there. Just don't wait. People procrastinate. They think they have time. And it does. It seems like it goes slow, and then it's fast.
Yep.
Personally, it is better to be early than 1 second too late.
Absolutely.
If you're 1 second too late, you are done with your choices. You have no choices.
Yep.
So I would encourage people to look us up, Lynette Zang, Zang, or ITM Trading. And we like to bring a lot of value to the table, and it's important that people understand what's going on.
Agreed completely. The point about it's never too early is, you cannot be late. I mean, it doesn't matter from any perspective. There's so many things. We had baby goats this afternoon, and we're early this year.
I love goats.
Yeah, and it was an easy birth and 2 girls.
Nice.
We couldn't ask her. It's like we asked the universe before we started. We said, easy birth, 2 girls. We got easy birth, 2 girls.
You must be doing something right.
Maybe. We'll see. All right, Lynette, you take care. You be well, and we will talk soon.
Thank you. Bye-bye.
Bye-bye. Well, that'll about wrap it up for episode 134 of the Gold, Goats, and Guns podcast. It's funny, in sitting down and getting to know Lynette, I actually now wish I had started this podcast in a different realm. Actually, I would now really like to sit down and talk with her again about all the things we talked about at the end of the podcast, the sustainability, the community, and all of those things. And I think that's what I'm going to do the next time I have her on the show, as an FYI. So I hope you enjoyed this one, and we'll be back soon with another hopefully stimulating episode. And you can follow my work over at my blog at tomluongo.me. You can follow me on Twitter at TFL1728. And you can sign up for the Patreon as well. It's Patreon.com/goldgoatsandguns, where we do a monthly retail investor newsletter, as well as biweekly market reports, regular private blogs, and have a pretty active private community server as well. So you guys be well. You take care. We'll talk soon. Keep your stick on the ice.